Yeah, I'll count to 3 and start then, okay?
Okay, go for it.
Well, good evening, everybody. This is the February 23rd edition of the Mid-Michigan / Manifest Investing Roundtable. It's co-sponsored by both groups. We've been doing this for about 11 years, and this is Ken Kavula, your host. I'm with the Mid-Michigan chapter, and I'll be joined this evening by 2 of our regular knights of the roundtable. It's Mark Robertson from Rochester Hills, Michigan, and Cy Lynch from Atlanta, Georgia. Our 4th knight is Hugh McManus from Pasadena, California. And Hugh just might be joining us later on, but his job is a very busy one, and he's at the moment doing his job. You can see pictures not only of the knights that we have with us. I'm the second person, the second actual person from the left in the top row, and Cy is the second from the right in the top row, and Mark is right in the middle of the second row down there. Hugh is next to Mark, second from the left. Going across that top row, that's Kim Butcher, myself, Herb Lemkohl, Cy Lynch, and Susan Machalik. I gotta get that name out there, Susan, correctly. Susan Machalik. Ann Manning in the bottom row with Hugh McManus, Mark Robertson, Matt Spielman, and our friend Nick. I'm drawing a blank. Strategos. Pittsburgh. Nick Strategos from Pittsburgh. Nick passed away about 5 or 6 months ago, but we honor him for not only for the great picks that he made for the roundtable, but because he was just an all-around great guy to work with, a real hard-working volunteer for better investing, and he is missed an awful lot. Let's get going. Like I said, we've been doing this for about 10 years. We do have some legal stuff to get out of the way real quickly. Everything we talk about tonight is for educational purposes. We're demonstrating a method of investing that goes back now to the 1940s. It's a method sometimes fondly referred to as sleep-at-home investing. It's long-term, true investing, and we're trying to put the power of putting together a really nice retirement in the hands of average, everyday folks in the United States to give them the understanding that it takes to either work side by side with a financial advisor or to become their own financial advisor. We do these programs, these roundtables, once a month, and we also do with Manifest Investing. Mark has been doing a program every Tuesday at 2 o'clock in the afternoon called Bull Sessions. If you'd like to sign up for a bull session and give that a try, please don't hesitate to drop Mark an email, and there's his address at the very bottom of the slide, Mark R at manifestinvesting.com. If you'd like copies of tonight's slides, that's the way you ask for them. And if you'd like to be added to the roundtable reminder list and all the other free activities coming from the Mid-Michigan chapter, then drop an email to my wife at nkavula1@comcast.net, and she'll add you to our reminder list, or look at the Better Investing website. That's betterinvesting.org, not .com, .org, and go to the Mid-Michigan chapter, and you can find a way to add yourself to our guest list. We contact about 1,300 people on a regular basis and let them know the programs that we're running, and we'd love to add you to that list if you're not already part of what's going on. Tonight is our anniversary, our awards night, and we're going to recognize the knights and damsels of the roundtable for various things that they've done. Here's our standing agenda. It doesn't change much month to month, but tonight we're going to talk about the awards, look at some scoreboards. We're going to challenge a couple of stocks in the tracking portfolio that we maintain. And then you're going to hear 3 stock presentations. The audience is going to discuss in a poll which one of those they like the best. And then if we have time, we're going to do a little bit of a discussion about CRISPR. That will depend on Hugh showing up. If Hugh doesn't show up, then the CRISPR discussion will be put off until next month. We always save time at the end for questions and answers. And folks, if we don't get to your question and answer after we close the session, we try to stick around and get as many of those questions answered as we possibly can before the next roundtable rolls around. So Mark, I'm going to turn it over to you. It's time for you to talk about this demonstration that we've been working on real hard now for over 10 years. So give us a background, a little bit about where the awards come from and how we're doing.
Yeah, thanks, Ken. It's a pretty simple premise. We just we want to demonstrate the methods and philosophy of the modern investment club movement. And we've been, as it says here, about last Tuesday of every month since 2010, coming together to share, basically to share ideas and perspective on investment opportunities. And as Ken reminded you, please do your own homework, but we are basically trying to bring you our single, at least an idea that's among our single favorite investment opportunities right now, and they're generally pretty actionable. When we say actionable, we mean study, not dial your broker. We do keep track of the portfolio of selections. These 11 years, we're trying to beat the market by 5 percentage points. That's 500 basis points if you speak that language. And we gauge ourselves versus the Wilshire 5000. We do want to see over half of our selections basically beat mirroring investments in the stock market. We've actually done that. We get the question every once in a while about, where do these knights and damsels come from? This is just one example. We notice people who seem to know what they're doing. Either that, or in my case, they're just lucky. Either one works, whatever it takes to generate a return. So what you're looking at here is the long-term track record of people who participate in our stock selection challenge known as the Groundhog at Manifest Investing. And you can see that there's a whole bunch of years involved here on the x-axis. We've been doing it for 14 years now. So that's the number of years are on the X, and the amount that these individuals have beaten the market, relative return is simply the amount that you beat the market by over these time frames. The 4 Knights of the Round Table are on the chart, and they're in red, and we would hope they should be. And I do want to point out, Herb is in the audience. You've heard from Ann tonight. I'm always going to miss somebody here, but here's Bower City. That's Susan Michalik's investment club. And you can see they have a pretty formidable track record. But again, these are people that have basically demonstrated and shown that they've got at least a knack for picking some stocks along the way. Special shout out here to the Sandy Castor, who just broke in with her 3rd year. You become eligible after your 3rd year. She actually broke our y-axis. She's done that well over the last 3 years. So we're all tipping our hat in your general direction of North Carolina, Sandy. And she's off to a pretty good start this year also. So again, it's basically a group of friends who have demonstrated an aptitude for doing this, and we just come together and share ideas. So with that, I'm going to start the March of the Knights. Our first award for this evening is for the best selection made over the last year. We define the last year as approximately the last 18 months. And this year's award goes to our preacher. He's had his hands up in the air all year long, right, Ken?
Hallelujah.
So he's there hanging out with his hands up in the air. Again, we just stuck a golden knight in it. And congratulations, Cy, for your selection of 5 Below. And you can see the track record at the bottom.
Well, thank you. I'd like to thank my mom and my dad. No, I will say before we move on seriously, we've mentioned Nick. Five Below, I think, won this award 2 or 3 years ago as well. And Nick, yes, you can see 2018. And that was a Nick Strategos pick. And I resurrected it during COVID when none of the stores were open. So.
Yeah, we were talking about it this afternoon, Si. You picked that, and I went, what? And, you know, I mean, all the stores were closed, and I mean, look at the performance there, going from $70 to $190 since March 31st, 2020. I mean, wow.
I related, Si, that just before your choice of Five Below was made, my investment club that owns Five Below had a heated discussion about whether or not we should even stay in the stock. We're usually not very divided when it comes to voting, and so we didn't even move towards a vote because I knew that it was going to split us right down the middle. So we just all agreed to disagree about it, and we kept it in the portfolio. And I can tell you, we're kind of happy that we did. But it would never have been a choice of our club at that point. You were very brave, and you were doing exactly what we're supposed to be doing when there's blood in the streets, as Mr. Buffett would say. When you're very afraid to do anything, look for good, solid companies that are just in temporary trouble.
Yeah,
that's it.
The story doesn't stop there. We have to continue to recognize Si, because that is a fireplace up at the top, but it's also in recognition that he's been on fire. I want everybody to notice the number of appearances here, and some of these were actually at the time. The Schwab one was even people were shaking their heads a little bit, but he's got 5 big time winners there here in the last year. You had a heck of a year, Si, so congratulations.
Thank you.
All right, and everybody noticed that.
So Mark, where's my Schwab picks?
They're probably just off the screen, just slightly. I can't look them up. You got to trust the scorekeeper.
Okay.
If you don't trust the scorekeeper, he can hurt you in the future.
Yeah, I know.
I do want to point out that BP and United Airlines, 2 selections which everybody went, offer Hugh McManus on the short list.
Mm-hmm.
Company's doing fairly well over the last year. So good enough. All right. Our second selection for tonight, second award, is for the best selection since the inception of the roundtable. So we're talking about an 11-year track record. And this one goes to me, Ken. So sometimes it pays to be the scorekeeper. And I did want to put a picture up there where I could say 2 guys talk stock and Ken Kavula not pictured.
Thank you, Mark. Thank you.
And for those, many of you out there know that inside joke, but that's a payback to the St. Louis Post-Dispatch on my behalf. Photographer Carson, to be specific, David Carson. Not that I would remember. But
and Mark, where's my OLED choice?
Actually, all of our 2 OLED choices are again just off the chart to the downside.
It's off the chart. Okay,
yeah,
all right.
I can
We'll get used to that answer tonight.
If you're going to demand a recount for every single category, Ken, I'll just send you the whole sheet. The one thing that we do want to point out is the ones that are highlighted are actually closed positions, basically sold positions. So the ones that are still in white are still active. So size 5 Below is right there at the top of the all-time list also. So is Ardelix from Hugh down at the bottom, that speculative pick that we've many of us, Wendy and I are actually shareholders, and I know many people out there are. And our wonderful company, local company, Dow, makes the list, the all-time list here within the last year. So it's been quite a year since March 31st, 2020. Notice how well those stocks have done in comparison. Okay.
Yeah, Mark, I'm getting some questions. That ANN at the top of the second last column, that stands for annualized, and these are annualized numbers, folks. So They're yearly numbers. So if you see that we've held the stock for 3 years, this appreciation was happening for 3 different years each year. That's not a cumulative return. It's an annualized return.
Right. And the only exception to that would be if a stock were held less than 1 year, it's the actual return. We don't bump it up to annualize it. It's just the actual return, absolute return.
Yep.
If it's held less than a year. So in the case of Dow, that's the case there.
In other words, you don't do a GDP drops by 33% or increases by 200%.
That's right. That's right.
Oh,
All right, so there's some interesting picks along the way there. Amazon is in there, Southwest Airlines, TJX, Ken, going all the way back in the contest. All right. We also keep track of how many of our selections actually outperform the market during their holding period. And here's the first place where Kim walks away with a couple of trophies, a couple more Golden Knights to add to her collection. She was actually 7 for 8 in the last year. She hasn't been as frequent a participant in the roundtable because the pandemic has kept Hugh chained to his desk. So fewer guest appearances for Kim, but she made the most of them. She went 7 for 8, and that actually propelled her back to the highest accuracy all time again. So 2 hat tips or standing ovations in the direction of Central Florida and Kim Butcher. In our Best Picture, the People's Choice Award for this year, I went with basically one of the more popular features, the webcast that we did for our 10-year anniversary last July. It was a blast. I went back and actually listened to part of it a few nights ago. It's just a whole lot of fun. Hughes Invest Like Spock, like Kirk was part of it there. Cy had a presentation that was highlighted in there. We talked about pulled pork, talked about Air Lease and Matt Spielman's presentation. A lot of the stuff that you see on this list was actually covered during that July 2020 presentation. So just for the sheer fun of it, some good picks also made that month. But a lot of good fun, and we'll just simply recognize that as a moment that was fun. Here's just a reminder of some of the stuff that was covered and stuff that we have covered in the last several years, along with a little bit longer list, including some of the other people that have been involved in the production end of this. Dan Hornick from Wisconsin for a while. Kurt every once in a while kicks in to actually participate, and he's the one behind the scenes that makes all the technology go. And we are deeply indebted to him also. So that was the actual program from July 2020. Any thoughts or comments, Ken or Cy?
No, it's just hard to think that we've been doing this for as long as we have, Mark. I don't know, Cy, if it's gone as fast for you as it's gone for me, but I can still remember some of those early presentations and how much fun they were.
Yep. Oh, it has flown by, and I remember some of them too.
Then, of course, you got to love the headdresses and hats. And, when we started this, Ken said no costumes. Actually said, okay, we'll do it, but okay, I'll do it, but no costumes. All right, let's wrap up the last couple of awards. This is the best annual performance in a leading role, and this was kind of foreshadowed a few slides ago when we showed that Cy has been on fire, so he's back with his hands in the air. He had the highest relative return for all of his selections in aggregate for 2020, and you can just see some of the picks scrolling down there. Everything from the winner, Five Below, and there he actually had a couple more positive ones on there, so pretty good across the board performance. I do notice that you managed to get an information consulting company in there, Cy. Couple times.
Absolutely.
EPAM's been pretty rewarding.
EPAM. Yep.
And Truist was another one that that was not on my radar screen, but that's definitely a hometown selection, I believe, for you.
Yes.
Pretty close to hometown.
Yes, hometown, more or less. I think Truist actually is, as a company's moving to Charlotte, the headquarters, but it's the former SunTrust Banks, which was hometown. And of course, Truist Park is home of the Braves. So those of you who remember the presentation, remember it was a baseball oriented pick and hometown. Go Braves.
Go Braves. All right. And our last award, kind of the last one before they start playing the music as midnight approaches, is for the best all-time performance. This is for the rate of return for the aggregate collection of selections made, and Kim has reassumed the lead in the contest with the highest rate of return as a participating guest damsel. So she loves to say ka-ching or cha-ching, and that's her on the right. She's actually with Dolores Park there, good friend of the better investing community, and just a good time to clink some glasses together. You can see that she's been in the lead 2 of the last 4 years. I will point out that 2 or 3 of the nights are within a percentage point of Kim in the all-time standings. So she can't rest on her laurels. She's going to have to keep generating that type of performance. This is a category that has been dominated over the years by Hugh McManus with some of his more unconventional picks, like the BPs and the United Airlines, and then a few going back over the years, including Amazon, that have performed very well over the years. This, and Ken, you mentioned that you have a resolution that you'd like to win an award. I'd like to see my name on this one.
Are you just tipping your hand for next year already, Mark, or we actually going to compete for it? So
I do believe there's a flavor of calculus that can get me there. All right.
Okay.
So if that's what it takes, but this is the one that I want. So, but again, congratulations to Kim, and she takes away the majority of the awards. She swept the awards in 2017, came pretty close this year. So congratulations, Kim. Sorry that she couldn't be here with us tonight. All right, so let's switch back to the actual portfolio, the tracking portfolio, and how we've done. Here's a look at the performance over the long term. What you are looking at here is a comparison of how well the tracking portfolio has done versus the Wilshire 5000. Going back to the 3rd year of the contest, we do aim for that 5 percentage point advantage to the stock market. That's the type of goal that many investment clubs have. You can see that we are at it right now. The rate of return on basically 1,000 investments or more, I don't remember the total number, is 18.5%, beating the market by 5 percentage points. And we hope to basically maintain and stay there. We have sagged a little bit as some of the mega caps that are in the portfolio have suffered here. In fact, this morning we were probably down even a little bit more with some of the activity on the market today, but Ken tells me that the market actually recovered by the end of the day. So,
well, the NASDAQ didn't recover, but the other 2 indices recovered, and some of the ones that we follow fairly closely came back to about flat, so that was pretty good too.
Okay, so a lot of good performance there in general. Just want to spend a moment talking about the fact that we did split the portfolio into 2 components, 2 pieces. In fact, at the bull session this afternoon, we talked a little bit about what I think was the evolution or heritage of that type of thinking in George Nicholson's encouragement that you should own a good stack of up, straight, and parallel growth companies, but not be afraid to experiment a little bit with the opportunities that come around with some companies with shorter track records. You can see the list of items there. It could be a low growth company with a deep value type situation, limited track record, a turnaround, all that type of stuff. It can make a lot of sense. And frankly, Kim Butcher and Hugh McManus spend a lot of time in that area, seeking opportunity while at the same time base loading their portfolio with a bunch of the companies that are on the left. The crime scene tape, by the way, is Ken and I encountered an investment club that was threatening to disband a few years ago. We talked them into staying together. They basically had a civil war going on between people who wanted to do up straight and parallel and some other more adventuresome people in the crowd that in that particular club. And when we attended one of their investment club meetings a couple months later, they actually put crime scene tape down the middle of their dining room and split into two groups. And it's a club with over 40 years in operation, and they continue to have a great time doing just that. So we did split the tracking portfolio into the two pieces. Here are the two pieces. We just refer to them as the core and the non-core components of the portfolio. And about 400,000 of the investments are in the core half, or the core component, and then approximately 70,000 in the non-core. And you can see that what the sub dashboards, if you want to think of it that way, add up to. And Ken and Cy, I'm pleased to report that we are 5 percentage points above the median projected return, the median return forecast for the stock market. So the portfolio has finally returned sort of to the promised land a little bit. We seem to be having trouble there for quite some time, staying 5 points ahead.
So I can raise my hands and shout hallelujah? Hallelujah.
We could put you on this slide too, I suppose, if that would be helpful.
Well, and you know, Mark, we've been working hard to push the sales growth up because we knew that eventually, if you push the sales growth up, you'd push the par up. And that's the first time in, I'm going to guess, a year and a half, maybe 2 years, that our par has moved back into the sweet spot again.
Yeah, it's been quite a slog for a while there. But in general, I mean, the portfolio's got a decent return now, a decent quality rating, a good blend of the up straight and parallel companies in combination with some of the more speculative stuff, and a decent growth rate. So let's take a look at the two pieces. Here's the core component. This happens to be just the top 20 by percent of total assets. So you're looking at just the top 20 companies in the core portfolio. If you go to this public link, you can actually see all of the companies that are in here. But what we do is we take, every time a decision is made or a selection is made by a knight or a damsel or the audience, we invest $1,000 into that idea. In the case of Microsoft, it's been selected 5 times. So $5,000 has been invested in Microsoft. That $5,000 has become, and that's almost a heart stopper, guys. It's up to $59,000. So that's how you use that legend to see how well the individual selections have done. You can see that universal display, Ken was asking about the ones that he thought might be missing from that roll call a few minutes ago. 4 times in universal display is now up to 27,000. And there's a couple on here that have actually only been selected a couple of times. Anything jump off the page at either of you?
I'm glad to see that we've maintained a few stocks that probably are going to be contributors as we move into reopening everything up. I'm awfully glad to see Booking still in our portfolio. I'm glad to see Five Below in the portfolio, Air Lease, LGI Homes. So we have some good solid core stocks that will definitely be benefiting as the economy moves towards a more open phase.
Yeah, now I would point out one here, Costco Wholesale. I'm pretty sure it's a one-time selection. I think Hugh McManus made that selection. So $1,000 invested in, I believe, 2010. In fact, I'm certain it was 2010. So that is just an example of what a single selection can do, given a little bit of time. Up 600 some percent. All right. Here's a look at the less traditional, perhaps a little bit more speculative part of the portfolio, the non-core part. And Amazon lives here. That's a 2-time selection. Amazon has been selected twice. The $2,000 invested in Amazon is up to almost $22,000. Of course, Amazon is a pretty good contributor to many portfolios. Ardelyx, if you're not familiar with it, is a company that's working on irritable bowel syndrome, and they've discovered that it has a side effect benefit for dialysis patients in controlling, it's either the phosphorus or the potassium. If Kim was here, she'd correct me, in renal care patients. And that's one that we've followed fairly closely over the years and has been mentioned 7 times. Any comments on this one, guys?
Well, a lot of our newer ideas are on this list, Mark, and I don't think there's anything on here that we should be giving up on yet.
I don't either. I think, again, these are going to be companies with a little bit less financial strength in most cases, perhaps a little bit less quality or a little more volatility. But, yeah, I don't see any reason to give up on any of these. All right. As far as what might be on the hot seat if we needed a hot seat tonight, and the answer is I'm not sure that we do. The 3 companies with the lowest return forecasts, as illustrated by their projected annual returns, are Booking, Forward Air, and EPAM Systems. Well, we don't need it for some because the portfolio is in the sweet spot, the overall projected return, and those are all fairly well above money market rates. So wide open to your thoughts, guys, but I don't see any reason to rush for the exit on any of these either. Look at the quality ratings.
I wouldn't. I mean, Ken already mentioned being glad Booking's still in the portfolio, and if he wants it there, then I'm all for. No, seriously. Although I would tend to agree with him, but without auditing Booking a little closer, because I follow it somewhat and I own some of it as well. I suspect it's probably got depressed expectations as part of it that maybe are not reasonable. So again, let's wait till things get a little more normal. Forward Air is somewhat the same, although I don't follow it at all, so I really don't know, but just my impression. Now, of course, EPAM has done that through performance, but again, since we don't need to increase the portfolio return, 4.5 for a core holding like EPAM is nothing to sneeze at either. So
yeah, I own Forward Air, Cy, and Forward Air has come back to where it was before we took that huge nosedive in March. But I think your idea about depressed expectations for a lot of these stocks that will benefit from the opening. This afternoon, when we were talking in the bull session, we looked at a series of stocks that would probably play into the economy reopening, and we noted the really low par values coming from the analysts' expectations on almost the entire set of stocks, and made the point that perhaps the pendulum for expectations has swung quite a ways in one direction, maybe a little bit too much, and they're going to have to raise expectations as we move to bring people back to a semblance of whatever normalcy will be in the next year.
Yeah, I would agree, and I think you're going to see that pendulum come back in many of those type of companies as the analysts regain their consciousness. The one that we might get a comment from, Cy, is Vmware. I don't know what you've done in Better Investing Magazine with it, but Vmware did lose their chief executive officer. He went to work for one of the major companies that escapes me off the top of my head right now, but they have had executive turnover. We flag these out as potential timeouts, if not sells, just for further discussion. So do you have any current thoughts on VMware?
I do not, although I'm in the process of getting ready to prepare an article, so I guess I'm in my silent period, although since I have no idea what I'm going to say yet, I haven't written it yet. I can probably talk. So really, I do not know a whole lot, but given uncertainty of changing over leadership And again, the discipline that I'm not 100% yet convinced is an appropriate one, but this is an experiment to help win me over or allow me to say a few years down the road, I told you so.
Okay.
We probably should stick with the discipline of selling it. But and that's a teaser for everybody. Read the next BI magazine. Let's say it probably won't be the next one to hit your shelves. It'll probably mailbox. It'll probably be the next one. But
well, it's
our audience is really good, Mark. They picked up the VMware exec went to Intel.
oh yes, yeah, and he's got his hands full there for sure. Well, I'm in favor of just riding out employers' holdings a little bit. Like Si said, we're still not 100% sold on this, but we have seen so many instances of where it prevented catastrophe for us. Alimentation Couche Tard is one that we just added to the portfolio recently, so I think I would just let that one ride a little bit and hope for reopening pressure. So I think we table them for now, guys.
fine with me.
And see what
If I'm reading this correctly, Mark, the new additions to the portfolio for Alimentación are not on this list. These are the 2019 additions that have lost, that are losing to the market right now, right?
Right. So we've got other positions that are not shown here. Yep. All right. So let's just go ahead and keep on trucking then for now. And I'm willing to let employers' holdings just kind of ride the storm for a little while too. All right, so with that, we're just a little bit after 9 o'clock. Let's go ahead and switch into our stock presentations. And Si would like to accumulate Axos Bank. So go ahead and take it away, Si.
All right. Thank you, Mark. And I will try and keep this brief and concise tonight since it is a repeat pick. Although when you do start deciding how to answer the poll, do remember the Golden Knights for last year's performance, both as a portfolio and a single stock pick.
Oh, just shameless, Si. Just shameless.
I need a drink.
Well, we're going to triple down. We're going to triple down on Axos Bank tonight. You can see up straight and quite parallel, more or less, as you see. Let's go ahead and move to the next slide. Tonight, I just decided to look at the portfolio and see what was there and accumulate an interesting holding. And Axos is, as you can see, it's the third highest pick. It's the one that I've picked the last, or made two picks in the last 4 or 5 months. And so said, there's my selection for the night, except let's check and see how it stacks up against its peers. Excuse me, next slide. So in regional banks, it's the highest potential return. Next slide. And ranking by growth, it is the highest growth company. I did not, for this month, rank it by quality, which I usually do, but notice it's got a 95 quality, which is very high and solid. But what was interesting when I did rank it by quality, the last 2 times I picked it, it was second to First Financial bank shares, and it fell in the rankings down to about 5th or 6th. I don't recall, but it's not that Axos declined. It's that there were a number of regional banks that had moved up in rank. I just mentioned that to say there seems to be some quality shifting to the positive side in the industry generally. Next slide. So again, just briefly, since this is the 3rd time we've done it in the last few months, don't need to talk a whole lot about the company. It's a digital bank. It's 20 years old, celebrated the 20th anniversary last year. And their real pitch is, we were born digital, we're focused on digital. So we know digital better than anybody else. Next slide. Just a quick summary. As I mentioned, started July 4th, 20 years ago. They operate 3 business segments: consumer, commercial, and securities. The last 2 is what kind of distinguishes them from some of the other online banks that you may think of that have either gone by the wayside or not, or are not doing as well. And it offers a full range of services from investment management provisions to, through all sorts of consumer and commercial banking. Next slide. Here's a new slide that I haven't shown you before, but it's just, there's 2 major profitability measures for banks, maybe 3 if you count return on assets, but net interest margin, which is the profit that they make on loans, borrowing money and then re-lending it at higher rates. And you could see that they've kept their margins right around that 4% in quite a varied short-term interest rate environment over the last 4 years. So that's consistency, and they do well there. And most of these slides came from a presentation, and you can see a bunch of other slides at the website that's at the bottom of several of these slides. Next slide. This is a couple of other measurements. There's the return on average assets that I had alluded to just a moment ago. You see it's well above its peers in the 80th percentile. And then the other key bank measurement of profitability is down at the bottom of this chart, efficiency ratio, which that is the non-financial cost, the brick and mortar, if you will, although Axos doesn't have a whole lot of brick and mortar, but they've got software and some buildings and so forth. Next slide. And of course, payroll is included in that. This too is what attracted me to it tonight, other than just being the 3rd highest in the portfolio, is that it's got a strong historical business performance. That was the first slide: rising sales, earnings, and pre-tax profit. But it's also kind of one of those. I'm not a momentum investor. I'm a value, quality value and growth investor. But I love it when I can get a stock that's got strong momentum behind it, along with good continued projections, and that's Axos Bank. I mentioned it last October for the first time, 53% relative return since then. In December, I picked it again. That was actually the November roundtable. It's up 30% over the market. So it has been doing extremely well relative to the market, and yet the par continues to actually increase a little bit, at least a manifest consensus par. Mine has stayed about the same, I think gone down maybe slightly, which y'all will know that's a little bit of defying gravity, but the reason it is business fundamental expectations are rising. Growth projections are going up. I increased mine from 16% to 18% this month, and manifests have been consistently increasing. Actually, each of the 3 times I featured it, it has gone up. Same thing on profitability, and likewise, the analysts seem to start believing in the company, and PE projections are increasing. Next slide. So here are my judgments: 17% sales growth rate. So I think I just said I increased it to 18 from 16. Apparently I went to 17. So 17%, and that's based on about the last 8 quarters. Its actual 5 and 10-year history's higher than that, but I think that's maybe a little aggressive, but we'll see. And then profitability is based on the last 10 quarters with taxes at its current rate. And I come up with $8 a share. Manifest consensus comes up with a little over that at 817, but roughly the same. And we're in the same ballpark with PEs. I'm just a little under the manifest consensus. And then let's see what those judgments look like. Manifest says 18.3% potential return, a bit above my 15.4, which is just a tad more conservative, but a very solid return. And of course, then notice if everything clicks on all cylinders, it could exceed 25%. So there's certainly some significant upside. So I'm tripling down on it.
Thanks, I. Yeah, it's certainly been behaving pretty well, and the analysts do tend to, they are kind of incrementally ratcheting up. So, all right. Well, Ken, I just noticed First Foundation on those screening results that Cy was going through. So you guys are shopping in the same barrel.
Well, I need to say that I struggled this month finding a candidate. I went to the same screen Cy did to start with, which was just nothing more than a dashboard of the portfolio as it is right now. I look strongly at Adobe that I had presented 2 or 3 months ago, but I just can't get past the PE values that are attached to Adobe right now. Although I really like the visual analysis, I like the analysts' write-ups on what's going on. But I just think it's too expensive in the long run for me to want to invest in. I did move finally into the financials, however, and I was looking specifically for a very small bank to maybe put my money into and be able to keep it there for quite a while. I wanted certain quality metrics to be in place, and I wanted certain numbers to be hit, but I wasn't necessarily looking for a slam dunk right off the bat. I found First Foundation. Click if you would, Mark. This is classified as a regional bank, but you'll find that it's a little bit different from your typical regional bank. It's centered in 4 main business areas. The San Francisco-Sacramento pool of investors or of customers is one of the pools. Las Vegas is the second. The Los Angeles, San Diego area is the third. And then the state of Hawaii is the fourth. Notice that I captured that paragraph from the company's website. The average household income in these 4 different pools of customers really beats the average household income in the US by quite a bit. It also beats the deposits based on the average. 50% of the footprint versus 23% nationwide for deposit growth. So deposit growth in these areas is wonderful, going right along with household income. That spells profit in my mind. Next slide, Mark. What these folks are personal bankers. They do a lot of private wealth management and an awful lot of trust services. You will find them offering traditional banking services, but only to their high worth customers. They do target businesses and they do provide services to certain businesses, real estate investors, but their prime candidate, their prime target for a customer is a high net worth individual or a multi-generational family that's trying to manage a large portfolio of things that are in trust. Next slide, please, Mark. The bank makes a big point of not having their investments tied to things that are COVID related. You can see that only about 2% of their commercial business portfolio is dealing with retail or accommodations and food service, and only about 3.5% of their non-owner occupied commercial real estate portfolio is tied to retail or to hotels. So they've put their money in places where COVID has not nearly been the problem, as you might find in retailers, in restaurants, in hotels, cruise ships, things like that. I like that idea, and notice that they have no exposure at all, for example, to the aviation and cruise industry. They've done a really good job of kind of walling off their investments for their clients. Next slide, please. They recognize that they have different client categories, and they tailor-made their services to those categories. For want of a better way to identify them, they've called them millennials, Gen Xers, and boomers, and you could see the types of services that they're offering to the different generations as you move along. I love the consume and distribute description for the category that I happen to belong to. It took me and my wife a long while to move from the accumulate phase of our lives to the spend and be happy phase of our life. But we've finally gotten there, and we're finding a nice way to spend part of our children's inheritance so that we don't leave them with too great a problem on how to spend a large amount of money. Notice how much this bank gets from their private clients. The average revenue is upwards of $16,000, $17,000 per client. So these are not cheap services that they offer, but obviously their clients find that they're valuable services because they're willing to pay significant money for those services. Next slide, Mark. I think the lifeblood of any financial institution like a bank or like this private bank or a brokerage for that matter is driven in many cases by loans. Loans are what make the bank operate and where the bank gets a lot of their funding from. And their loans have grown at a beautiful pace since 2016, over 17% compounded annual growth rate in loans. And that amounts to about $2.5 billion of loans since 2016. This is still a small bank, but the growth is impressive. Next slide, please. So here we come to the SSG. I've been telling many of you in the audience for years now, and I've been getting on my soapbox and preaching it to anybody that will listen, that you need to expect from your small companies the same kind of lines, the same kind of growth that you expect from your larger companies. If I were to see these lines and somebody told me it was a large company, I wouldn't be surprised, but I'm a little bit surprised to know that this is a small company. These are not as common as you might expect, and to find these up straight and parallel lines in a very small company, in a bank in this case, is something that I feel real good about. Notice that there's price bars being attached to this data only from 2014 onward. So this has been a public company for the last 7 years. The first two sets of data from 2012 and 2013 are prior to the company becoming public, and you might even chop those off of there when you're doing your analysis. I've added a line that the tool allows me to add showing me the growth in assets for this company. And actually, when you're looking at a bank, that's one of the things you really are trying to examine. How have the assets grown over the years? And you can see that that line is fairly parallel to the sales line and to the earnings line. And therefore, the growth is doing exactly as you want it to do with assets. I've circled one of the numbers down at the bottom of the tool. That line is measuring return on average assets, ROAA. It's an important metric, and our bank examiners in our volunteer nation have told us that 0.85 is a pretty normal number for an average bank. And when this number hits 1, the bank is doing okay. When it hits 1.25, it's quite good. And when it hits 1.5, it's very good. I'm really, really pleased with the general upward trend of return on assets, especially during the last 5 or 6 years when the bank has really gotten into its we're not a brand new guy on the block anymore kind of growth. And I would anticipate that this ROAA number would continue to rise towards that 1.5, which is extraordinary in the banking world. And if it does move in that direction, that's only a great thing for me if I own this particular stock. I love the character of the lines. This is exactly what I want to see in a young, up-and-coming small company. And this is where I'm willing to put my money down, especially if the PE values are reasonable, and then sit and wait for the stock to grow into what my expectations might eventually be. Next slide, Mark. Here's the PE history, and you can see the current PE, or this is, I guess, yesterday's PE, was 11.8 compared to a 5-year average PE of around 15. When I did this SSG, I used estimated sales and earnings growth of about 15%. I used a high PE of only 15 and a low PE of 7. My decision was to set bars that were easily attainable. If the company does better than this, and I fully expect it to do better, then my payout, my appreciation is going to be better as well. This is, in my mind at least, a very reasonable, quite conservative stock selection guide. I used an 18% payout ratio for the relatively small dividend that the bank is paying right now, although the yield is up around 3.5%. It's giving me a buy with a best case return about 22%, an average return, if I use the average PE 5 years from now, of around 15%. And what I always like to do, whether it's a young company or an old company, is I like for validation. I like to compare it to where manifest is coming from because thoughts are from the analyst community. So next slide, please. One more slide, Mark. There we go. And I go to the manifest page. Oops, back one, please. I go to the manifest page and I find that it's a good quality company, quality of 69 with a par of 13.2. That's close enough to my par of 15 for me to feel validated in my analysis. There is no chronicle, and that's something that I feel because I really, really like to depend on the chronicle. But there's no chronicle for this particular company because it's new to the manifest database. I wouldn't expect anybody to go back and recreate SSGs for every month for the last 5 years and then give them to me on a graphical basis. That's exactly what a chronicle is doing. So I'll start to get chronicle information as this company stays in the database for longer periods of time. So I'm kind of running right now with my hands eyes for some of the tools I normally do. Analysis tells me that I have a pretty good chance of making it through the next year or 2 or 3 with my expectations still in place. So there we are. First Foundation, FFWM. I would put it in the portfolio.
Thanks, Ken. You were dropping out for me, but it may have been me dropping out. So if I do happen to drop out, send me a note.
It happened to me too, Mark, once or twice. So I suspect it may not be, but hopefully you won't drop.
Okay, well, one of us, if not both of us, are probably having internet challenges. I will try to be brief. Here's a company that's been in the community for a number of years, Richie Brothers Auctioneers. The picture up at the top is one that I actually saw while traveling in Illinois just a few days ago in Morris, Illinois, just southwest of Chicago. And you have this field of equipment. So this is an infrastructure theme. These guys basically are matchmakers, putting equipment, suppliers, and manufacturers in touch with people who need their hardware. And that's actually a dated picture. All of their current auctions are done online. Just not that long ago, they would do exactly what you see there with an auction and delivering equipment and lots of it. I mean, you drive by there on the interstate, you can see all these derricks and stuff up in the air, and it's a lot of fun. I do like to share some of the places that I went sniffing around for ideas. I was really torn this month. I thought really hard about Bristol Myers Squibb. That first one there, the 100 Club, these are companies that have the highest combination of elevated return forecast and quality ranking. And basically the top 1% of all companies. I always like to shop on this list. DR Horton's on there. Size selection for tonight is on here. Axos Financial. Gentex, Employers Holdings actually makes this list, another reason to kind of hang on. I'm intrigued by Bristol Myers Squibb. It's also in the portfolio. SEI Investments has been in the roundtable tracking portfolio for 10 years. So there are some very interesting studies on that list. Another one that I always like to take a quick look at is the companies that have the best chance of qualifying as triple play candidates. And there's a bunch of very interesting companies on here, from eHealth, one of my Groundhog Challenge selections for this year. And I'll just leave it to you guys to study, but Bristol Myers shows up on this one. So I have to wonder if he were with us, if he wouldn't be leaning towards Bristol Myers a little bit. But a good shopping list. By the way, eBooks got cut in half today, if you hadn't noticed. Apparently their auditors walked off the job, and there's more to the story. We'll have to see what's going on there. The third screen, and I really do like to do this one, especially when I'm shopping for perhaps a little more speculative opportunity, is to shop amongst the companies that have the lowest relative strength index. These would be the most oversold or undervalued companies out there. And you can see that this is where I basically centered on Richie. It's third on this list, and fairly decent numbers across the board. They're nothing terribly flashy, but in a market like this, I don't want to be terribly flashy. A little more quality, a little more financial strength, and grabbing for a little less gusto is sort of what I have in mind. The price chart that you see there is exactly what has created this opportunity. Just a few months ago, it peaked near $80 a share, and it has receded to $50 a share. And you can see that it spent a little bit of time down around 30 here today and over the last couple of days. So it is a potential opportunity in that regard. You can read for yourself what they do. They basically supply equipment to construction. Again, think infrastructure. One of the other things that I do like to notice about companies from the value line description is some of the institutional holders. One of the more accomplished and promising small company ETFs is Janice Henderson. And notice that they're a fairly significant holder of this company. I also kind of like that there's a lady in charge of a construction-related company. Kind of neat. That might make me a chauvinist, but maybe not. Here's a look at the sales trajectory over the last several years. The bump or the step up is their acquisition of Iron Planet, which was another online auctioneer that was pretty accomplished in the field. So they simply just combined forces. So you really want to pay attention to the continuing business from 2018 on. That is a growth rate of 10 or 11%, the slope of that red line, looking at the history and the forward-looking projections. Notice that they are distributed amongst 13 countries, including some of the most promising construction and frankly maintenance and repair areas around the world. And they're no small players. They've got over 2,000 employees. Here's a look at their profitability over the last several years and the look going forward. Again, you have to discount the the distant past as being kind of the company one, and in the blue circled area, that's the combined company. And they do seem to be settling into the low teens for their net margin as their percent net margin as their measure of profitability. So 10 or 11% growth, 14 or 15% net margins seem to make a lot of sense for this company and its business model. And the third milestone judgment that we focus in on during our studies, in the case of Richie Brothers, they have been in the 30 range for PE ratios. You could argue maybe trim a little bit off of that going forward as they mature, but high 20s is certainly something reasonable for the foreseeable future for Richie Brothers. So here are all the components put together. Notice that the stock price has taken that dive over the last 3 months from 70-ish to 50-ish. You can see that we are talking about a $1.4 billion company growing at 11%. Value Line has a 14.5% projected net margin. I stuck with that. I also stuck with their 27 for a PE. Again, that was something that could be justified somewhere in that 27 to 30 range. So again, we're talking about a company not too flashy of a return, but a 12% return forecast when the average company out there right now is 5% is compelling to me without, trying to set my hair on fire. Notice that they have reduced liabilities, a little bit less cash on hand, but their projected return on value with the price decrease is actually above average. They don't have a lot of debt. They do have a little bit of debt because they're a capital intensive company, but pretty decent interest rate, reflecting the bank's opinion that these guys are pretty good from a financial strength. The reason that they're here, a low relative strength index this morning was down around 23. So potentially undervalued under these conditions. So I'm going to go ahead and go with a company that has been a community favorite for quite some time, dating all the way back to the iClub list, and add Richie Brothers to the tracking portfolio. So with that, Ken, can we go ahead and run the poll?
We certainly can, and here we go, Mark. While you're voting, there have been gremlins in the GoToMeeting this evening. I have lost some of my questions in the questions box. If you've asked a question that we have not answered at this point, could you type it in again if you get a chance, if you really want an answer? I don't know why I've lost some of those questions, but I have. We're approaching 80% voting. I'd love to get us up to 90% voting. It's free, doesn't cost you anything. Just choose one of the 3 companies or tell us you don't like any of them, and we can get our poll going at that point then. Okay, we did move over 80% at least, so I'm going to close the poll and I'm going to share the results. And it looks like Cy's shameless advertising there at the beginning won the day. So congratulations, Cy.
Well,
Whatever works, y'all are just jealous.
you give a guy some golden hardware and the audience just flocks to him. Ken and I are over here standing by the wall.
So we'll add $1,000 in Exos Financial for Cy's pick and another $1,000 for the audience pick, and we'll see how it does into the future here. Mark, you want to, I got to hide this now, don't I? There we go. Okay.
Are you hiding?
Back to you. I have to hide the poll. Back to you then, Mark.
All right. Well, Hugh obviously was not able to join us, and he has promised a discussion on the investment potential with respect to CRISPR, genome technology, Nobel Prize winning stuff from this year, and we'll have Hugh talk about opportunities in the realm of CRISPR. From the little bit that I've studied it, there's a whole bunch of fields of potential study, including some Frankenstein type stuff, and it's just an interesting area to explore and talk about. So we will do that in the future.
What's really interesting also, Mark, is that there's a number of publicly traded companies that are dealing with this technology. So it might be a place you can look for an investment as well.
Yeah, do you happen to know Simulations Plus does anything in this area?
No, I don't.
Okay, maybe we can check into that for future purposes. All right, just real quickly, coming attractions, we do the bull sessions on Tuesdays at 2 p.m. If that's in the middle of your work day, we do archive the recording and make them available on YouTube. We'll show you that in a second. Ken and I will be doing an Indianapolis e-conference. One of the reasons we love to do that is the home of the first remote chapter for the National Association of Investors. And we've just had wonderful times with Indianapolis audiences in the past, and thought we would make a cyber visit down there. The March Roundtable is on March 30th, a month from now. And we have a save the date type moment here for our Successful Investing 3 webcast that takes place over a period of 3 days in May. It's nicknamed COVID Cancellation Conference number 3, CCC number 3. Hopefully the COVID cancellation stuff will not require a fourth edition of that event, Ken.
I hope not, Mark.
Number three's a charm, and future conferences can actually be in person. Speaking of in person, the National Convention for NEIC Better Investing is in Dallas this year, and in October. I didn't splash the days on there, but we'll restore those on there here shortly. All right. Just a quick, we'll just let that one sit up there for a minute. That is the session that Ken and I will be doing in Indianapolis in March. And just a quick reminder that if you go to YouTube and just search on Manifest Investing, we do archive all of the sessions. You can see that the Tuesday bull sessions are there. The last couple of weeks in February have featured a look at some of George Nicholson's early writings in the early days in the evolution of investment clubs back in the 40s and 50s. We had some good fun tearing into a couple of those here over the last couple of weeks. And Nicholson did regard February as invite a friend or help people to discover investing for the month of February. And let's just kind of hope that that can continue. We have had some requests here today for matching people up with investment clubs. That's always a wonderful thing. Notice that all of the roundtables are also showing up here, as well as the conference from a few months ago, Successful Investing 2. Those sessions are also available. Any comments or questions on that, Ken?
No, we do have some questions in the audience here, and let's get to them after we close down the session. Okay, Mark?
All right, so I guess we'll just wrap things up by saying congratulations, particularly to Mr. Lynch and to Kim Butcher, who took away the lion's share of the golden hardware this year. So tipping a glass of Coca-Cola in your general direction, Cy, and saying congratulations.
Thank you, sir. And so sorry that Kim couldn't join us, but congratulations to her too. So.
Oh, he's cruel, Ken.
No, he said Kim. Kim, he said.
Oh, he said Kim. Okay.
Yes, Kim.
Well, that's better.
But
Cy
congratulations, Ken, too, for
Cy doesn't normally rub things in, Mark, so we're all set, okay?
All right, well, congratulations to everybody, and we're off and running on another year, and thanks to everybody. Any closing comments, Ken?
No, it's this is always a little bit of a different kind of a feel for this one session that we do, but we'll be back on track at the end of March, last Tuesday in March, and we hope to see lots of you there as well. Good night, everybody.